Okay, in this video, we're going to talk about asset disposal. And that is when you sell or otherwise dispose of an asset before the end of its useful life. And companies do this all the time when they, restructure away from one line of business to another line of business, or there's many other reasons to dispose of an asset. Let me show you how we account for this type of a transaction. And we'll use Target as an example. And the question is, what if, so we're going to imagine a transaction. What if Target decided to sell all of its PP&E? Okay, so Target is just exiting the business altogether. They're going to sell every single piece of property, plant, and equipment that they own. They're going to sell it on February 4th, 2018 for $30 billion in cash. So they got some buyer who wants to buy all of this PP&E. Here it is. So what I'm showing you is an excerpt of the balance sheet. And all of that is Target's property, plant, and equipment. They have land, buildings, fixtures, computer stuff, construction in process, and all of that stuff has accumulated depreciation on it. And what they show on their balance sheet is net property, plant, and equipment of $25 billion. Note that this is in millions. So as of February 3rd, 2018, they have $25 billion worth of PP&E in terms of book value on their balance sheet. They're going to sell it for $30 billion in cash. So hopefully you have some initial intuition here that they're going to have a gain of somewhere around $5 billion. But let's talk about how we account for this type of transaction. We'll sell all of this PP&E for cash. And so always, when you're thinking about a journal entry, is cash involved? Yes. Is cash coming into the business or going out? It's coming into the business. And so we'll increase our cash balance with a debit to the cash account. And so we'll debit cash for $30 billion. And note that we're in millions on the balance sheet here. And so my journal entry, I'm just going to stick with that basis, okay? So my journal entry is in millions as well. So 30,000 million is a billion. And so debit to cash for $30 billion. And now what do we need to do? Well, we're giving up our PP&E in return for this cash. So we need to completely remove these PP&E balances from our books. How much do we need to remove? Well, we're selling this stuff on February 4th, and so the amount on our books is just going to be the same as it was on February 3rd, essentially, okay? So we're going to remove all of these balances from our books. We have land of $6 billion, and that's a debit, right? That land account is a debit balance. How do we get rid of a $6 billion debit? We credit for $6 billion. So we'll credit the land account for $6 billion. And now we'll just go down the line. We'll credit buildings and improvements for $28 billion. We'll credit fixtures and equipment for $5.6 billion. We'll credit computer hardware and software for $2.6 billion. And we'll credit construction in process for $440 million. Okay? Now what do we need to do? Well, all of these things, what I just listed there was their gross book values. But some of these accounts depreciate over time. So not land. Land does not depreciate over time. Construction in process, also that is not depreciating yet. Target will start depreciating that when they place it in service. But the middle three accounts here, they're all in the middle of their depreciation. And so while we get rid of their gross account balances, we also need to get rid of all of that accumulated depreciation. So you can see that has a negative $18 billion balance. That's a credit balance, okay? It's a contra asset account. And so that's a credit of $18 billion. To get rid of it, we need to debit that account, $18 billion. And that reduces the account balance to zero. Okay, so here we've done it. We've taken in $30 billion in cash, and we've completely removed all traces of these assets, including their accumulated depreciation, from our balance sheet. But if you pause the video and add these columns up, the entry doesn't balance. And the reason is we got more cash than the net book value of all of our assets, right? The net book value was $25 billion. And so what we need to balance this journal entry is either a debit or a credit. So if we received cash of less than $25 billion, we'll be recording a debit. But since we received cash of more than $25 billion, we need an extra credit to balance this journal entry. And the amount that we need is $4,982,000,000 to balance the journal entry. And the account that we plug it into is just, I'm going to call it a gain account. And this shows up on the income statement. It's a non-operating gain. So I'll write that non-operating gain. Okay? And this number is a plug. Okay, we had to calculate this number. And again, if they received cash of less than that 25 billion, 18 million, then they would have needed a debit to balance this journal entry, and that would have been called a loss. Okay, it's still a non-operating loss on the income statement, but we would just call it a loss since it's going to reduce net income, whereas this gain is going to increase net income. Okay, and that's how you account for the disposal of an asset.